Hello, ladies and gentlemen. This is Christopher Aaron. Welcome back. It is March 20th. This is going to be a quick update, but there was an important Fed meeting today, and I just want to cover that briefly. The Federal Reserve meeting today, and as we expected, not raising interest rates. The important takeaways are that the Fed indicated they would most likely not have any further increases in 2019, although they did talk about having at least one rate hike in 2020. So it seems like they're not done yet, at least at this point. We know they're wavering quite a bit, month to month, depending basically on what the stock market is doing. So this idea of the Powell put, as they call it, in other words, that Jerome Powell stands ready to do anything to keep the stock market from falling, is alive and well. So this is the type of world that we live in these days. It's not right. There is nothing about the Federal Reserve's charter from 1913 that authorizes them to do any meddling in asset prices or to support one market versus another. But basically, at this point, the charade is over. They've basically just admitted that that's what they're going to do, and so we have to work with the system that we find in front of us. So let's take a look at how this impacted the precious metals. Now, the other big thing is that they indicated today in the meeting that they may possibly be done normalizing their balance sheet. This was a big thing over the last 2 years. They were talking about the spike up, how much money did the Federal Reserve print over the last 10 years. We were looking at an increase of about $3.5 trillion, and they were trying to extinguish some of that debt. They had extinguished about $500 billion. And they've been saying the entire time that they're going to bring it all the way back down to neutral. In other words, extinguish the full $3.5 trillion. They got $500 billion in, and they basically have balked at this point, to borrow a phrase from baseball. They've basically said, actually, we probably can't do that. So, all the promises that were made in 2008 about, hey, we're going to extinguish this money. Don't worry, it's not inflationary. Ben Bernanke, getting on TV, Hank Paulson claiming all of this stuff is not going to be inflationary because we're going to extinguish it. Well, that just gets flown right out the window when push comes to shove. So we can see what the Fed is doing. Now, how did this impact the precious metals? Let's look. So definitely a nice surge here in gold over the short run, breaking through the recent resistance that we've seen for the last 3 weeks around this 1310, 1311 region. Flipping over to silver. Silver is basically still just testing its respective resistance zone, which is right here around 1550, 1555. So we're at that zone right now. Let's put everything into perspective. As you know, we look at things from a technical basis here on this channel. We are very focused on what is actually happening to the price of the metals themselves. We have a key. Now we're looking at gold here. This is spot gold from August. This was the low of the major decline, the almost $200 decline that we saw from May through August of 2018. Here was the exact low. So we can see the kind of shape that this recovery has been taking in something of an initial channel, which then began to break higher here. You can see by the dashed lines into a more aggressive channel. Okay, so notice the shifting to a more aggressive stance with gold. Now notice right over here, however, just in late February, you can see that this more aggressive channel was broken, right where my mouse is, right there at 1,315. So the more aggressive channel was broken, came back and bounced basically right on the upper side of the original channel. You can see here in black also, we're talking about some of these swing lows at 1276 through 1280. So kind of the confluence between the upper original channel boundary supporting gold prices here and this flat horizontal support zone. So where does that leave gold right now? Now here's the key takeaway is that the negative divergence signals that we have been talking about in recent weeks here on the free channel, and we've been covering these extensively in the premium service. These negative divergences have not improved whatsoever. When we're talking about all these factors that we're looking at, we're talking about the ratio of the gold mining sector, the unleveraged gold miners versus gold. When we're talking about the gold to silver ratio, when we're talking about the stock market to gold ratio, when we're talking about the relative performance of the Japanese yen versus gold, a lot of these signals that we follow, these negative divergences that I've been talking about, these have not gotten better at all, even though we've seen, what is this, a $38 move here from the recent bottom at 1280. So what can happen is that these negative divergences can be leading for quite some time. And it can be frustrating because we're paying attention to this, which has a negative connotation for gold. We're paying attention to a lot of these negative divergences, and we're taking protective action, yet gold itself is not respecting the negative divergences. So when I see this kind of thing in the past, I then have to take a step back and kind of say, okay, so the negative divergences hold, they remain, but where are we with the actual price of gold? We have to look at where potential resistance points are for gold. And if I'm looking at this chart, I would say the real obvious one at this point is the confluence here of these recent highs from January. We can see that the attempt by gold here to get over this level and then backing down. And then we can see that this level served as support here, 1321 to 1327. Then it failed. And so we're coming back up to that level now, which also corresponds here within about $10 or so of the broken, more aggressive channel that gold was in. So it's always the case that when you have two resistance zones within a narrow range or so, you place a probability there. So this is our latest probability. Now, what would be the one signal? At this point, there's only one signal that I could possibly see that would tell me that this is going to be one of the extremely rare times. Basically, the only time, to be completely upfront with you. I've studied gold going back to 1968, 1970, the freely traded era. Basically, this would be the only time that I have observed the host of the negative divergences that I'm right now still seeing in gold. This would be the only time, if it's going to break out, that it's just going to do that. This would be the only time that I've ever observed something so divergent as we are seeing. And so the level that I would be watching, it's not this high, not this 1345 high. It would be the 2016 high. I need to see that 2016 high taken out, and then, wow, we have a different ball game on our hands. We have a market that's just going to forge its own path higher despite all the signals, the cautionary signals. This is what I see in gold at this time. Let's switch over and look at silver. Now, silver has been acting weaker than gold, basically for the last 2.5 years. And we can even see little hints of that here on the short-term chart. So look at silver. It was basing, right? So gold made its low here in August and then hasn't looked back since. Silver made a new nominal low in November, just below $14. And so here's a bit of a short-term base underneath the $14.90 to $15 range. So notice breaking out of that base, and notice how it came right back here and retested this level, which corresponds with all these swing highs in here from last fall. So coming all the way back to testing that level, and this also corresponds, this $15 level, if you can see that, corresponds with the less aggressive rising trend from the absolute low. We're talking this blue primary trend, the less aggressive trend from the low. So notice how these two levels come in at exactly the same point, and look at where silver bounced. Right? There's no other way you can connect this low with the next major significant low and not arrive at this point. Now, I should say, so we're talking about the less aggressive, the more aggressive trend that silver was in up here. We can see that was already broken. So I've changed that to the turquoise color. So that's broken. Silver is now facing, as I said, that resistance right at this 1555 or so level. We can see the support here at that level and then failed, and it was rejected here just a few days ago. And it's now testing. It's nominally above that level, but let's see what happens, for example, tomorrow, especially into the close tomorrow. So if silver can overcome this 1555, from a short-term basis, it really clears the decks to kind of rise back up to challenge the recent highs here as well. You can argue that there's some minor resistance in here in the 1580 to 1590 region. Really, this is the next significant resistance. But, the big picture for silver, I'm not going to bring up that chart, but I just want to let you know, this is still, this entire move here off of the bottom, which is just taking its sweet time to round up and figure out what it wants to do here. But this entire move off this bottom in our model is still considered counter-cyclical to a larger, more powerful downtrend that is still in play. And that is the case until proven otherwise. And we will bring up some of the longer-term charts in future weeks. But I just have to tell you, the level that we're looking at very closely, which would indicate that we have a new rising primary cycle on our hands for silver, is $16.60. So if you think about that, that's only $1. It's only $1 above. But notice I have defined levels that I'm talking about that switch the primary cycle that we are in. It's not like I would be missing the entire move if silver goes $1 higher. We're talking about a metal that could easily go back to 50 within the next few years. But the downside risk is that silver could fall, especially past these recent lows, and that it could fall down to 12 or even 8 and change in a worst case deflationary type of scenario. So I have to see, there are certain levels that I have to see still with silver that are going to clear the path. Now, from a fundamental basis, what appears to be on the table is a Federal Reserve that is basically bowing to the markets. And of course, they're going to have their own reasons for doing that. They are going to, basically they're looking out for their member banks, which are mostly involved in the financial markets. So if the broader stock market is getting weak, it's going to hit their banks. So this is why they're altering the course of the interest rate hikes now. However, and this is a big however, the Federal Reserve is not all powerful. Let's keep this in mind. If they were all powerful, and it was simply, they could print as much money as they wanted to and bail out the system whenever they wanted to, then the stock market would not have crashed 60% in the crash of 2008. Okay, and let's just remember what happened to gold and silver during the crash of 2008. Silver fell more than the stock market. Gold did not fall as much as the stock market. It fell only about 30%, but it still fell. Right? And so even with a Federal Reserve that is shifting policy to try to bail out the system, we can still see that there is risk, even to the metals, even for individuals who understand the problems with the system, which, yes, I agree with you. There are immense problems with the system. But when we study what's actually happening in the market still at this point, there are all these unresolved negative divergences that are still showing up, as I mentioned, across the precious metals complex. There are all these unresolved negative divergences, and we see gold and silver, continuing to advance here over the short run. My major point, though, is that we are not at the levels yet that I would have to see broken for this model to become outright bullish. We're not at that point yet. And let us remember, last but certainly not least, the Federal Reserve is not all powerful. So we can't hang on their every single word. There is a series of services that I offer. If you're an individual and you would like to speak one-on-one with myself or by email, this is for individuals who have unique situations in the metals and you would like to speak to someone who does not sell the metals. I do independent research and analysis, and I simply look out for the best interest of individuals. That is my business model. I'll never get everything 100% right, but I will put an independent, researched perspective onto things. The premium service that we do offer is called Precious Metals Intelligence. This contains everything that we are doing here as a firm, as well as members-only videos that are like this. The next one goes out in a week and a half. It's going to be like this, but about an hour and 15 minutes in length. We do a deep investigation of everything that is happening across the markets, including gold, silver, the US dollar, the stock market, and the bond market. So that is available. You can find more on that on the website if you are interested. I would be remiss if I didn't thank the individuals supporting this channel on Patreon. Thank you so much once again for your support, and I do hope that you find some value in these videos. In the future, I'm going to try to see if I can do some Patreon only videos, but right now I am literally up to my eyeballs in work and charts that I cannot take on any other projects at this immediate moment. That doesn't mean I'm not going to do it in the future, and I really do appreciate your support. Also, don't forget to hit the subscribe button so that you will get notified when these videos come out. I try to do them once a week. I can't promise every single week, but I do my best to do that. So thanks for tuning in. We see the levels where gold is finding support. Silver, we see some resistance levels that are potentially coming in. And please keep in mind that just from someone who has nothing to sell other than analysis, the negative divergences that we are seeing still are still there in the metals. They're still there, even though the metals have moved higher. The Federal Reserve has basically got the market in its pocket right now, but this institution and all institutions, they are not all powerful.